Hello, everybody. Thanks for joining. I'm Ben Cotton. We're with Tony Landa. Tony, what are we doing today?
We are announcing two new assets for Fund 4. First one, 32 Union, located in Noblesville, Indiana, right in our backyard. We closed on that May 11th, and we're already happy with its performance. Number two is we're under contract to acquire UPTOWN TERRACE in Rogers, Arkansas, right next to Walmart's headquarters. And so, new market for us. We've been looking in this market for 3 to 4 years now, really studying, and we finally found an asset that we really, really like that's in Fund 4.
Great. Well, so before we get into it, let's get through the disclosures. So if you want to read all this, go ahead and pause your screen. Obviously, nobody needs to make a decision based on a 10 or 15-minute webinar. So please make sure you download our offering memorandum and talk to your trusted advisor. By the way, we do have an SSID number, which is with Charles Schwab. So if your investment advisor wants to learn more about what we're doing or we want to work together, happy to do that. At the end, we'll do our phone number, email, all that stuff. You can get in contact with us. So Tony, go ahead and introduce yourself for those. Most people may not know you, but if they don't, just quick, let us know who you are.
My name is Tony Landa. Really quick, I'm the Chief Investment Officer for BAM. Been in this real estate game since I was a teenager, to be quite honest. So closing in on 30 years. Been fortunate to work for a few reputable firms, institutional capital, private equity. Been in acquisitions, asset management, portfolio management, dispositions, acquisitions. I don't know if I said that already, and joint venture development. And so I'm kind of a one-trick pony in that regard, is that I know real estate. And so that's a quick introduction to me.
Yep. Nope. And I'm Ben Cotton. I've been in business development for 20 plus years. Some would say that's what I've been doing my whole life. But more specifically to multifamily real estate, I've raised over $650 million in debt and equity, all for multifamily projects. So that's a little bit about me. Let's jump into it. So Tony, maybe you can tell us a little bit about BAM Capital for the folks that don't know us.
BAM Capital is really a function of the BAM companies. We're fully integrated. It's very, very important to our business. We're operators at its core. And so you have the BAM companies and you have BAM Capital, which is really investor relations and acquisitions and asset management. We have BAM Management, which is our operations team. And then we have BAM Construction that takes care of our properties. And so we're all in-house. It's very important to our investors. It's very important to us. We don't do any third-party type work. We've had an extremely good track record over the years. I think we've exited 12 deals, more than 12 deals, and returned more than a 30% IRR and a 2.5x to our investors, net to the investors. Transacted in over $1 billion worth of deals, 6,000 units. And so our track record really speaks for itself.
Yeah, I think it's fair to say that we are operators and not speculators. Is that a fair assessment?
That's very fair in this industry.
And not common, right? Because a lot of the groups you see that do this, they really are kind of financial engineers and speculators. Their model's not really operations. They're financial engineers and speculators first.
Oh, absolutely. And they rely on things that are outside of their control, where we rely on things that are within our control.
Great. All right. Well, let's jump into the first one. Let me hit the button here. Why is it? Oh, there we go. Sorry about that. So tell us about 32 Union. We talked about it. It's in Noblesville, Indiana.
Institutional quality asset built in 2019. I absolutely love this property. Outstanding location in Noblesville, which is an affluent suburb of Indianapolis. Within a 1 mile radius of this site, population growth of 191% since 2010. And that is an outstanding, that metric should speak for itself. Strong in-place cash flow, consistent cash flow, below market rents by as much as $150 a unit, to be quite honest. This is arguably the best asset, the best location in Noblesville, and it has the lowest rent per unit relative to the competitive set. Year-over-year rent growth has been 19%. We feel there's a lot of management operations upside here. We bought from an out-of-state owner, but this is our backyard. We know the operating expenses on a per unit basis. We can get within probably 3% of it. We know where the rents have to be relative to the market. We own 6 assets here already, roughly 1,300 units, and so that's we know the market colds, and so we think we can achieve plenty of economies of scale with other assets that we own in the area. Limited new construction nearby, best in class amenities and unit finishes, exceptional school system. So I love this asset. I've walked it many a times. I wouldn't mind living here, to be quite honest, Ben.
Yeah, no, it's a beautiful place. I mean, if I lived in the area and was moving to the area, I'd live here. And for perspective, this is what, a 10, 15-minute drive from essentially our corporate office, which is where our training center is for our employees. So, I mean, we have a lot of central resources that we can throw at this if we ever have to.
15 minutes tops, and that's with traffic.
Gotcha. Well, I'll go ahead and go to the next slide. So talk about value add. So again, some of our investors that don't know us, or some folks that don't know us, when they hear value add, they think about, cabinets and flooring and granite countertops and that sort of thing. But this is a new asset. So maybe explain to folks kind of what our approach is to value add in multifamily.
Yeah, our value add is what I said earlier. We focus on things that are within our control, not outside of our control. And so we'll first look at operating expenses and see where we might be able to reduce costs if applicable. We do everything in-house, and so there's really not a whole lot of service contracts with our properties. That saves us a significant amount of money. So we'll look at operating expenses and see where we can create operating efficiencies and economies of scales with the other assets we own in the area. We also have, I'm not going to spill our secret sauce, but we also have some proven processes to boost ancillary income, application fees, admin fees, pet fees. The big one really is utility reimbursements. We know what the market will bear, and we have a system where we really try to recapture 90 to 95% of our utility costs. Like I said, in the rent here, we don't really rely on it too much on rent increases. It doesn't really make or break our portfolio. We rely on the other things that I mentioned. But here, like I mentioned earlier, you have the best product, you have the best amenities, and arguably the lowest rents in the market. And so those 3 things are absolutely huge for us, and from an acquisition standpoint and a management standpoint. And there's definitely not a lot of new supply in this area, which is also helpful.
Now, and let's talk about, we kind of talked about location. Noblesville is anybody who lives in Indianapolis understands it. But again, for those that don't, talk about Noblesville a little bit. And you kind of talked about it, but maybe there's some supply, lack of supply in the area, which is one of the hallmarks we look for.
Yeah, and I'll get to that in the later slide, but just high level, this location is outstanding. Like I said, 191% population growth within a 1-mile radius since 2010. That should speak volumes. Outstanding, highly acclaimed school district with this. So I personally like to buy more 2 bedrooms and 3 bedrooms than 1 bedrooms. One, it reduces your turnover costs because you tend to cater to families that want to be in good schools. And so that's a key demographic for us. The other demographic too is, Hamilton County, this property sits in Hamilton County, and which boasts the highest average household income, roughly $135,000, and home value of $350,000. Highly educated workforce, exceptional location. And also, too, is the big thing is its connectivity to the other affluent suburbs of Indianapolis, Carmel, Westfield, to name a few. They are key economic drivers. Indianapolis, the suburbs, have a very diverse economy. And so you are within 15 minutes of major economic drivers in good jobs. I'll say that.
Fair enough. I'm going to go to the next slide if that's all right.
Yeah, go on.
Yeah. So we talked about, we talked about schools, talked about demographics.
Talked about the amenities. You can move on to the next one.
Okay. So quick financial overview. Remember, these are our projections. They're not a guarantee, but we have a high conviction that with this property in the fund, a whole period of 3 to 5 years, we expect a 15 to 20% IRR, meaning again, no guarantees, high conviction that 2 to 2.2 equity multiple, meaning if you invested $100,000 with us, we have a high conviction that within 3 to 5 years, we'll be able to refinance or sell this property and return to you a 2 to a 2.25x on your invested capital. Might also point out that the loan to value is pretty low. I mean, 65%, I don't know what it is across all real estate. That's probably not a number that somebody knows, but 65%, meaning that for every dollar invested in this property, we've got essentially 35 cents that's from our equity. So
right, and so I'll say too, under due diligence, we obviously have to get a third party appraisal, but we bought this on an in-place cap of roughly 5.25%. And if you've known me for 5 minutes or talked to me for 5 minutes about real estate, you know the in-place cap is meaningless to me. But the appraiser valued this one an in-place cap of roughly 4.8%. And so we feel that we got a really good deal on here. And so while we're buying it at a 5.25 cap, we're really taking that 5.25 cap and taking it to a 7 to a 7.5. And that's where we add value with operating expense reductions, ancillary income, and some modest rent increases to really boost the NOI, so we can get the stabilized cap to a point which will produce all these returns.
now it makes sense. So just to summarize, we're saying that if we buy a property, we're not as concerned at the cap rate when we buy, because we take our systems, our processes, and increase how much money that property makes, and therefore essentially force appreciation on the property.
Exactly. And so if I buy, said another way, if I'm buying a property for $100 and it's currently producing $6 in NOI before debt, that's a 6% cap rate, right?
Yep.
I'm looking to take that $6 to $8, which is an 8% cap rate. Well, the appraiser just put a 4.8 on this thing. That's a big delta, and that's all profit to me. And that's the most important metric when evaluating real estate.
Yeah. And you said we bought at a 5.25 and it was appraised at a 4.8. What does that translate to? We're basically saying it appraised for X amount of dollars more than we paid for it.
Exactly.
And what is it, like a couple of million? I don't know. I'm just
probably not that high, but like $1.5 million. Sure. Yeah.
got it. All right. Market overview. We kind of talked about that. Is there anything you want to hit on this slide, Tony, on Noblesville?
Yeah, definitely would. So Indianapolis really, for the first time in a long time, actually it's actually firmly positioned in the top 5 markets for rent growth. In fact, the top 6 markets, I believe 3 to 4 are Midwestern cities. And so the Midwest is really held up in terms of rent growth as opposed to some of the Sun Belt markets. One thing that's key for this particular location, it is one of the lowest percentage, I mean, for all of Indianapolis, one of the lowest percentage of deliveries to total inventory in the entire country. So I think Yardi Matrix at the end of 2022, rent growth for Indianapolis MSA was 11.3%, if I'm remembering correctly. The number of deliveries to total inventory was 1.3%. That's an incredible stat, and it's why we like Indianapolis so much. And like I mentioned, I said this, I think, twice now, population growth of 191% since 2010 within a 1-mile radius. Household incomes, average home value, extremely high, educated workforce, and like I mentioned, strong connectivity to Carmel, Fishers, and Westfield, some of the top markets in all of Indianapolis.
That sounds great. Let's shift gears. So let's talk about Uptown Terrace, Rogers, Arkansas. We've been pining to get into this market for 2-3 years now, and finally have the opportunity. So Uptown Terrace, Rogers, Arkansas. Let's talk about it.
Similar characteristics. I mean, it's a middle of the fairway for us, just like 32 Union. We are under contract to buy this, expected to close in July, whereas opposed to 32 Union, we did close. So first 2 assets of Fund 4. Institutional quality asset built in 2021 by a very renowned developer. Exceptional location anchored by 3 Fortune 500 companies, and we can get into that a little bit later. Strong occupancy and in-place cash flow. We feel that there's significant management operations upside. That's what we specialize in. We're buying from a very, very prolific developer who develops very good product, but we think we can, from a management perspective, we can add a lot of value there. We feel that the rents are below market because there's a lot of first generation leases in place. This asset just stabilized not too long ago, and there's a lot of first generation leases in place, and I can get into that in a couple of slides. Proven leasing demand, limited Class A supply, limited new Class A supply in the surrounding area, best in class amenities, and it's extremely visible and accessible, which is key to a good real estate development.
Yeah, that allows us to drive traffic to the property, right?
No question.
Yeah. All right, next slide. So again, we don't need to get too deep into it. A similar value add strategy that we have with 32 Union. So is there anything you want to, I mean, it jumps off the page to me, the fact that we can look at rent, rents are $240 below market. So let's talk about, the value add strategy and location for Uptown.
Yeah, not only that, but first we're going to start with operating expenses like I did with 32 Union. We're operators at its core, and we know how to operate these assets. We've transacted. We just know, we know it. We're experts in multifamily. That's all we do. That's all we're going to do. And so we think there's definitely operating expense reductions. I won't get into too much of the detail. Again, ways to boost and maximize ancillary income and in rents that are $240 below the competition. One of the reasons why I mentioned it, first generation leases, this property leased up at 30 units a month. That's an incredible absorption amount. And a lot of times developers focus on their occupancy and not maximizing rent, especially in the first year of lease up. They're concerned about occupancy. Well, this thing had an incredible lease up. And so we think there's a lot of meat on the bone from a rent perspective when looking at the competitive set because of these first generation leases. Location, killer location, absolutely killer. Located in Rogers, a high-end city in the Northwest Arkansas MSA. Like I said, anchored by 3 Fortune 500 companies in Walmart, Tyson Foods, and J.B. Hunt. Actually, Walmart is currently constructing a new global headquarters, which is 10 minutes from this site. It's a 350-acre campus that'll house 14,000 jobs. So So we couldn't be more excited about the location and the asset.
Yeah, it's interesting. I actually read an article not that long ago about Walmart saying, look, we're closing down some of our tech hubs. You're not working from home. And if you want to work for us, you've got to be in Bentonville. So this is amazing for us.
No, absolutely.
Talked about institutional quality asset. Did we talk about population growth?
Population growth. I mean, Northwest Arkansas has seen consistent job growth over the past decade. I mean, they've added 65,000 jobs, representing a 20% increase from 2010 to 2020. Population also grew by 25% from 2010 to 2020, which are, I mean, it's some of the best statistics in the country. So
again, with the financial overview, again, these are projections, not a guarantee, but certainly high conviction that, again, within 3 to 5 years, we expect a 15 to 20% IRR to investors and expect a 2 to 2.25x return on invested capital in a 3 to 5 year period, either through an opportunity to refi because we've increased the net operating income considerably over that 3 to 5 year period, and or sell, depending on what the market is at that time.
Yeah, I don't think I have anything to add to that. I mean, I can get into the stabilized yield on cost again, Ben, but you're probably sick of hearing me talk about it, and I just went through it with 32 Union.
No, we get it. So we bought this because we thought the current operator was doing just an okay job.
Yeah, and we're currently on site today conducting due diligence. We were there yesterday and today. We walk every unit. We audit every lease. We have our maintenance team and construction team there checking out the site, and so we found some things. So we're pretty happy with this acquisition thus far.
Nice.
Actually, it's not acquired yet. I'm sorry. It's under contract.
under contract, important. Anything to add on this slide? We kind of talked about some of the employers in the area. I don't know if there's anything you want to add from the kind of the retail and employer overview in this in Rogers, in Bentonville, the suburb there?
I don't think so. I mean, Walmart obviously is the 10,000-pound gorilla there. They're expanding. All of their vendors have to be in the area if they want to do work with Walmart. That's a big plus. The only thing I will mention, I mentioned Tyson Foods, JB Hunt. The only thing I will mention is education is a big part of it. University of Arkansas in Fayetteville, just south of this site, is a pretty big economic driver for it, and that's not going away anytime soon.
Talked about most of this. Is there anything on this slide you want to hit?
Yeah, so like I mentioned, it's one of the fastest growing MSAs in the United States. Population increasing by over 25%. I mentioned that. Anchored by Walmart, Tyson's, I mentioned that. Year-over-year job gains in North Arkansas have outpaced the national average since 2010. That's a remarkable stat, in my opinion. Sub-market vacancy currently sits at 5% roughly. Year-over-year rent growth, pretty steady, 5%, 4 or 5%. And here's another telling stat to me is the positive net absorption in 2022. That is atypical of many markets that reported retreating demand and rising vacancy in 2022. Rogers didn't do that at all. And it just speaks to the growth in terms of population and job growth. Obviously, and also what we really like, a nationally recognized school system district that's serving over 16,000 students. And one other point I want to make on this slide, which really bolsters apartment demand, is that home values, single home values here in Rogers, the Bentonville area, have doubled in the last 5 years. So it's making it a little bit unaffordable for people. So people are flocking to the apartment market. And so that's a really key, that's a key stat that we look at. And it's really bolstered the apartment and the fundamentals here in Rogers.
Yeah, not to mention, look, in the last 6 months, that mortgage has become even less affordable because rates have gone up. Not to mention, lenders have gotten a little more bashful and they're requiring more money down. It just, it drives more people to rent, right?
No question. No question.
All right, Tony. Well, maybe let's just take a couple of the questions we've gotten and we can close this out. Okay.
Absolutely.
So first question, when's our next acquisition?
I get that from Ivan and Adam all the time. We see a lot. We're seeing a lot of opportunities. We're seeing marketed deals and we're seeing off-market deals. It could be as early as this week, to be quite honest. Putting a deal under LOI. There's a lot of opportunities on our plate. The reason being is there's a lot of people that are on the sidelines and they're trying to save their powder, trying to wait for everybody to get back in the game. But I've been through 2 real estate cycles, and my pencil was down, and my pencil shouldn't have been down, but because they would have been great buying opportunities, and so we're seeing a lot of good opportunities at very fair prices that we wouldn't normally see in a normal market.
Yeah.
And what about, Ben, tell us about the fund and the fund structure, Series A, Series B,
Yep.
Equity. We get that question all the time.
Yeah. So Fund 4, for those that are not in yet or haven't seen the other webinar on Fund 4, Fund 4 will be a maximum of $150 million. We talked about it earlier, 6 to 8 properties, very similar to these in similar markets. And we've got Series A and Series B. So Series A investors are those that say, hey, look, I want to know exactly what I'm going to get every month. It pays somewhere between 9 and 11%. And typically, when money is placed, you'll see your first check within like 30 days. B investors, that's where I typically invest. So B investors, that's a 7% preferred return, typically not current, but it is accruing, and that's to investors first. Then we get caught up to a 7%, and then everything after that is split 80% to investors, 20% to BAM Capital. And these are the investors that traditionally in the past have seen that 30% plus IRR. Not really a lot of cash flow on the front end first couple of years, but on the back end, that's where the big payday, as they say, goes at that 3 to 5 year point when we either refinance or sell a property.
It's a great answer. Thank you.
No problem. I get it. You were excited to ask me a question because most of the questions go at you. So final question, interest rates, Tony. get a lot of question about interest rates. You know, what are we doing about it? How does that affect the properties, that sort of thing? These two properties in particular.
Yeah, so these two properties, we'll put, floating rate debt on it. The main reason being because there's a lot of value add. There's a lot of meat on the bone for these assets. So if we execute our business plan like that we plan to, we in year 2 or 3, we'll have the option of either to pull our equity out and refinance and go with Freddie, Fannie, maybe HUD, probably not HUD, or we'll be able to sell. It really depends on the market conditions. But we want to float. We want to have that prepayment flexibility. We don't want to be trapped into yield maintenance. We don't want to be trapped into defeasance. We want the flexibility, but we self-escrow. So we try to manage our interest rate risk by self-escrowing, putting something on large cash reserves on our balance sheet that are called owner's reserves. So in case interest rates rise, I don't think they're going to, based on where they are today, we're covered. And if they actually fall, hopefully they will, we can take that money and distribute it to our investors. And so that's kind of how we balance our risk and try to maximize our returns to the investor.
So put simply, we match the debt to the strategy, right?
Correct.
And we reserve a lot of cash so we can sleep at night if interest rates go up.
Absolutely.
Makes
Thank
sense.
you for simplifying it.
So, all right. So that's all the questions we'll do. And so on if investors want to learn more, they want to invest, they want to ask questions, they want to schedule time with, somebody on the team, you can reach out to us at our email address, invest@BAMCapGroup, or our phone number down below. Or you can just go to our website, which is capital.thebamcompanies.com. Tony, thanks so much for taking the time.
Thank you, Ben. Thanks, everybody.
Thanks, guys.